So, there's been quite a few videos about Deutsche Bank recently. I thought I would go back through the timeline and come up with what Reuters have been writing about for the last 30 days or so. First of all, June the 6th, former Deutsche Bank co-CEO included in Cum-Ex probe. So, German prosecutors are probing former Deutsche Bank co-chief Anshu Jain and 78 other current and former bank officials as part of an investigation into a divided tax stripping scheme, German daily Handelsblatt reported on Friday. Investigators suspect managers at Deutsche Bank and other banks of helping to exploit a loophole which allowed two parties to claim ownership of the same shares, making it possible to claim dividend tax rebates running to billions of euros. The scheme, called Cum-Ex, involved several other global banks. The Cologne prosecutor's office is also probing Garth Ritchie, the head of Deutsche Bank's investment banking arm, as part of the investigation. Citing unnamed sources, Ritchie, through a Deutsche Bank spokesman, declined to comment. The scam, which for years operated in a legal grey area until prosecutors declared it to be fraudulent, is being investigated by several prosecutors' offices, including by officials in Cologne. Deutsche Bank acted as leverage provider to two clients who were involved in the scam, Handelsblatt reported. Süddeutsche Zeitung said that fraudulent tax claims related to the 2009 business year, running to more than €1 billion, would expire soon unless prosecutors press criminal charges. Reuters reported in January that investigators had found indications that senior managers had discussed reputational risks related to the Cum-Ex scheme, which sparked Germany's biggest post-war fraud probe. June the 11th, ex-Deutsche Banker ruled the roost in Frankfurt, Euribor trial told. A former Deutsche Bank banker who ruled the roost in Frankfurt was part of an elite group that gamed the global financial system, seeking an edge over counterparties in a 5-year rate rigging plot, a London trial heard on Tuesday. Such was the sway of German Andreas Hauschild, a former managing director, that he only accommodated convicted Deutsche Bank star trader Christian Bittar's rate requests when it suited his own trading needs, a prosecutor alleged. Hauschild, a 54-year-old who ran the bank's team responsible for rate submissions, denies any wrongdoing and sat impassively on the glass-surrounded dock as Jane Waddington outlined UK Serious Fraud Office's case against him. Where there was a conflict, Mr. Hauschild got his own way. Mr. Bittar was not accommodated because Mr. Hauschild's wishes prevailed because he ruled the roost in Frankfurt, Waddington told the jury at Southwark Crown Court. Hauschild is charged with conspiracy to defraud over alleged manipulation of the Euribor, the Euro Interbank Offered Rate, a Brussels-based benchmark that helps determine the rates of around 180 trillion of global financial contracts and loans. Euribor, like its LIBOR, London Interbank Offered Rate counterpart, is designed to reflect the cost of borrowing between banks and is set after submitters at a panel of major banks report their estimated costs of borrowing over various periods to an administrator who calculates an average. The jury heard that Bittar had already been convicted over the conspiracy along one-time Barclays trader Philippe Mariusseff, ex-Barclays senior rate submitter Colin Birmingham, and former Barclays derivatives trader Carlo Palombo. Waddington said the convictions proved a conspiracy, and it was up to the jury to decide whether Hauschild was part of it. June the 16th, Deutsche Bank set to set up €50 billion bad bank in revamp. Deutsche Bank is planning to overhaul trading operations by creating a so-called bad bank to hold tens of billions of euros of non-core assets, a source close to the matter said on Monday. The overhaul, first reported by the Financial Times, will also include shrinking or shutting equity and rates trading businesses outside of Europe. The bad bank would house or sell assets valued up to €50 billion, £44 billion, after adjusting for risk, and comprising mainly long-dated derivatives. The measures are part of a significant restructuring of the investment bank, a major source of revenue for Germany's largest lender, which has struggled to generate sustainable profits since the 2008 financial crisis. It is trying to turn itself around, but has faced hurdles such as allegations of money laundering and failed stress tests. Its attempt to create a German champion through a merger with Commerzbank failed in April. In May, Chief Executive Officer Christian Sewing promised shareholders tough cutbacks at its underperforming investment bank. June the 17th, Deutsche Bank plans to pare US equities business to skeleton operation. Deutsche Bank plans to dramatically reduce the size of its US equities business, leaving only a skeleton operation in place where service corporate and high net worth clients, three sources familiar with the matter told Reuters. Chief Executive Officer Christian Sewing is battling to convince investors he can turn around Germany's biggest lender, whose shares hit a record low this month. He told investors at the annual meeting last month that Deutsche was prepared to make tough cutbacks at its investment bank. A member of Deutsche's supervisory board discussed those plans on a call last week and agreed that large-scale cuts were necessary in the bank's US equities and rates trading businesses. A complete retreat from US equities was discussed, but the preferred option among board members was to keep a presence in the market and continue developing the bank's electronic trading capabilities, the source said. It is not yet clear how many of the bank's 9,275 US staff will be affected, and the sources said no final decision has been made. The plans are expected to be unveiled when the bank reports first half results next month. The bank is keen to maintain substantial debt capital markets and credit trading businesses in the US, having identified them as businesses with growth potential, the sources said. It will also retain sizable M&A advisory businesses. Sewing is looking to shift the German lender away from investment banking to focus on more stable forms of revenue, such as transaction banking. The US equities businesses have been a drain on profitability for several years, promoting some shareholders to call for its closure. JP Morgan's banking analysts estimate it loses between 200 million and 300 million euros each year. After the 2007-2009 financial crisis, Deutsche maintained a large presence on Wall Street, even as European rivals like Credit Suisse made big cuts. Encumbered by litigation and regulatory investigations, the business has struggled to compete with Wall Street rivals. June the 18th, Deutsche Bank considers replacing CFO. Deutsche Bank Chief Executive Christian Sewing is planning a major overhaul of top management, including replacing the finance chief, Bloomberg news agency reported on Tuesday. So this is James von Moltke, CFO, destined for the axe. Citing an unnamed person close to the matter, Bloomberg said that Sewing could remove James von Moltke as CFO. Separately, Germany Business Monthly magazine reported that Sewing was also discussing the possibility of replacing Garth Ritchie as head of investment banking, to make the planned restructuring of the division a top priority. So, June the 19th, Deutsche Bank seeks to shed risky assets as part of overhaul. Deutsche Bank is aiming to cut up to a quarter of its riskiest assets in the next few years, people familiar with the matter said, shedding more light on how the German lender is trying to overhaul its business and revive profitability. The plan provides more detail on a restructuring expected since Chief Executive Officer Christian Sewing promised shareholders tough cutbacks to turn the bank around after it botched an attempt to merge with rival Commerzbank. Deutsche's biggest businesses by revenues is its investment bank, which holds swathes of high-risk assets such as complex derivatives. Cutting back on risky assets would, in theory, allow Deutsche to hold less capital and use this money for other purposes to try to boost profit. Under the plan, Deutsche will reduce its so-called risk-weighted assets by 20 and 25% over the next 3 to 5 years, people said, speaking on condition of anonymity. Risk weighting is where the bank assigns a risk of losses to an asset, such as a derivative or loan. That, in turn, determines how much capital it needs to cover such a loss. The revamp will delay further some of the bank's goals. Deutsche is widely expected to miss its key profitability target, a return on tangible equity of 4% in 2019. But competition is heating up on Deutsche's home turf. Standard Chartered earlier this year opened its new European Union headquarters in Frankfurt, next door to Deutsche's head office. The bank aims to take on Deutsche's core clientele, big German corporations, by offering them services in far-flung countries, Standard Chartered CEO Bill Winters told reporters on Tuesday. June the 19th again. Deutsche Bank faces FBI investigation for possible money laundering lapses. U.S. Federal Bureau of Investigation is examining whether Deutsche Bank complied with laws meant to stop money laundering, a person with knowledge of the matter said on Thursday. The inquiry, first reported in the New York Times, follows a report by that newspaper last month about bank employees in the U.S. Compliance Division who had flagged suspicious financial transactions to their superiors, who then opted not to escalate them to government authorities. The transactions were notable because they were linked to companies controlled by US President Donald Trump and his son-in-law and advisor Jared Kushner, according to the report. Trump rejected the report last month, saying he had little need for banks because he had so much cash on hand and denying that money came from Russia. The resulting FBI investigation is viewed as routine following the report about the bank whistleblower, said the person, who spoke on condition of anonymity in order to talk about ongoing investigation. A Deutsche Bank spokesman declined to comment on the Times report, but said, "We remain committed to cooperating with authorized investigations." Kushner Companies said allegations about its relationship with Deutsche involving money laundering were completely made up and totally false. The FBI, the White House, and the Trump Organization did not immediately respond to requests for comment outside business hours. The NYT reported a Trump Organization spokeswoman as saying she was unaware of Deutsche flagging any transactions. The lender, Germany's largest, has been making progress, working its way through a raft of litigation over the past years, but it has recently made headlines about lapses in safeguards meant to identify money laundering. In 2017, regulators fined Deutsche Bank nearly $700 million for weak controls that allowed money laundering from Russia. A U.S. Department of Justice investigation is still ongoing. Earlier this month, a group of U.S. Senate Democrats urged the Federal Reserve to investigate Deutsche Bank's relationship with Trump and Kushner. Deutsche Bank has long been a principal lender for Trump's real estate business. A 2017 disclosure showed that Trump had at least $130 million of liabilities to the bank. June the 20th, Deutsche Bank braced for continued Fed restrictions on U.S. businesses. Deutsche Bank AG executives expect U.S. regulators to continue to impose restrictions on its Wall Street investment bank, even if it passes an annual health check, three sources familiar with the matter said. Executives hope improvements the bank has made to its risk management and capital planning processes since failing last year's test will enable it to achieve a conditional pass this year, the sources said. The optimism is based on conversations with Fed officials over several months. However, the Fed has yet to give a final decision, and the bank's fourth failure in 5 years is still possible, they said. The Federal Reserve has implemented annual tests of lenders after the 2008 financial crisis to check whether they have sufficient capital to weather a major economic downturn. Even if the bank passes the stress tests, executives expect the Fed to continue to bar it from making payments to its German parent without the Fed's approval, the sources said. They also anticipate Deutsche will be told to continue improving the systems it uses to monitor its businesses and risks. The tests this week and next come amid uncertainty over the bank's U.S. operations. Deutsche plans cutbacks to appease investors unhappy about its stock market underperformance. It also faces investigations by the Federal Bureau of Investigation and Department of Justice into possible money laundering lapses. The bank has said it is cooperating with investigators. Deutsche flunked the second part of the test last year. The Fed cited material weaknesses in its data capabilities and capital planning processes. The bank said in April it had invested heavily to ensure that the bank meets regulators' demands and has made significant progress. The Fed officials recognize the bank has made improvements to its processes, but believe more work needs to be done to bring them up to required standard. This year's tests are likely to be the last for Deutsche's U.S. business under current America's head, Tom Patrick, the sources said. Patrick is expected to leave in the coming months as the bank's U.S. restructuring progresses. Patrick declined to comment, but bank officials said. June the 25th, former Deutsche Bank executive denies helping Bitar rig IBOR. A former Deutsche Bank managing director charged with manipulating global IBOR interest rates on Tuesday denied helping convicted trader Christian Bitar and said any assistance his team gave his former colleague was inappropriate. Andreas Hauschild, who ran the bank's Frankfurt team responsible for rate submissions, told Southern Crown Court he was unaware of such conversations in 2005 and that it was inappropriate to request rates to suit trading positions. That is not what you do. It is not proper, the 54-year-old German said on his first full day in the witness box. He said he first saw communication between Bitar, a former Deutsche Bank derivatives trader, and his team after prosecutors from the UK Serious Fraud Office sent him documents about the case. He is charged with conspiracy to defraud over the alleged manipulation of the Euribor, Euro interbank offered rate, a Brussels-based benchmark that helps determine rates on around 180 trillion of global financial contracts and loans. So Bitar was sentenced to 5 years in prison. Here you see him nearly a year ago, jailed for 5 years for rigging lending rates. And I believe they were given a total of 9 years. That's Carlo Palombo, Colin Birmingham, and Christian Bitar. June 27th, 2019. Deutsche lifted by Fed stress test passed in boost to Wall Street operation. Deutsche Bank's shares rose by as much as 4.8% on Friday after Germany's biggest bank passed an annual health check by the US Federal Reserve in a boost to its beleaguered Wall Street operations. But the Federal Reserve placed conditions on the US operations of Credit Suisse after identifying weaknesses in its capital planning, knocking the shares in the Swiss bank as much as 1.1%. The test assessed whether it is safe for banks to implement their capital plans, including extra capital for stock buybacks, dividends, and other purposes, beyond providing a cushion against losses. They are designed to avoid a repeat of the taxpayer bailouts of 2007 to 2009 financial crisis. Deutsche Bank, whose US business has been plagued by litigation, underperformance, and regulatory investigations, topped the German blue chip index GDAX in Frankfurt after its US shares went up as much as 6% in after the bell trading on Thursday following the Fed's news. Deutsche Bank Chief Executive Christian Sewing said, "Achieving success here was one of the key goals we set up a year ago. It is a huge step forward to our business in the US and globally. A strong operating platform in the Americas is essential to our clients," he said. June the 30th. Deutsche Bank in wealth management hiring spree. Deutsche Bank plans to hire 300 more relationship and investment managers for its wealth management business by 2021, as part of a plan to bulk up in areas the German lender hopes will bring steadier revenue streams. Deutsche Bank is in the middle of a major restructuring as it tries to shrink its investment bank that has struggled to generate sustainable profits since the 2008 financial crisis. The shake-up is expected to lead to thousands of job cuts in areas like equities trading. Chief Executive Christian Sewing wants instead to allocate more resources to businesses that have more stable revenue streams, with wealth management one of them. This drive to grow our business is now materializing with a big investment push, Fabrizio Campelli, global head of Deutsche Bank Wealth Management, told Reuters in an interview. Under Campelli's plan, the number of relationships and investment managers will grow by 300, about a third of the current numbers globally. They will be spread across America, Europe, and emerging markets regions. We need to increase significantly our client footprint, which means net increase of client-facing individuals needs to be material, he said. Wealth management is attractive to banks as it requires less capital and its earnings tend to be less cyclical. But it is also highly competitive. Swiss banks UBS and Credit Suisse are already big players with wealth management at the heart of their business models, while upstart fintech companies are also trying to make inroads. The space is very crowded and the market is one that many banks have sought to make their mark on, said Campelli, who has run the business at Deutsche since October 2015. Campelli, an Italian who has been at Deutsche since 2004 would not disclose the bank's long-term uh, assets under management target, but said, if we can't improve from just outside the top 10 position, I will be very disappointed. June the 29th, Deutsche Bank board to meet July 7th to decide on job cuts. Deutsche Bank's supervisory board will meet on July the 7th to discuss a major restructuring that may result in as many as 20,000 job cuts. CEO Christian Sewing flagged an extensive overhaul last month when he promised shareholders tough cutbacks to the investment bank to turn the lender around after it failed to agree a merger with rival Commerzbank. In addition to the job cuts, Germany's flagship lender is considering trimming its management board, three of the people said. The management bank would be represented on the board by Sewing rather than having a seat at the table, as is currently the case. Veteran Garth Ritchie has been heading the investment bank, but a plan under this discussion to promote bankers Stefan Hoops and Mark Federick to lead the division as co-heads, two of the people said. They would report to Sewing. After years of failing to keep pace with Wall Street's big hitters such as JP Morgan and Goldman Sachs, Deutsche Bank is being pushed to retreat from the riskier investment banking and focus its efforts on mainstream markets. Deutsche Bank held talks with Citi BNP on shedding chunks of equities business. Deutsche Bank has held talks with Citigroup, BNP Paribas, and others over the possible sale of parts of its equities business, the Wall Street Journal reported on Tuesday. Deutsche Chief Executive Christian Sewing said in May he planned to make cutbacks in the bank's investment banking and trading operations so as to appease investors unhappy about its performance. Shares in German lender hit a low record last month. Sources told Reuters last month that Deutsche's plans to cut the size of its US equities business, leaving only a skeleton operation to service the corporate and high net worth clients. The business had struggled to compete with Wall Street rivals. Deutsche wants to wind down the assets or sell them. However, it may be a struggle to find other banks willing to take them on, analysts say, though they say private equities buyers could be interested in taking them at a deep discount. Deutsche Bank to axe investment bankers in up to $5.6 billion revamp. Deutsche Bank is preparing to unveil a sweeping multi-billion euro overhaul within days that would see the axe fall heaviest on investment bankers, sources familiar with the matter said on Wednesday. The revamp is expected to cost the bank up to 5 billion euros, and one of the executives said. Chief Executive Officer Christian Sewing flagged an extensive restructuring in May when he promised shareholders tough cutbacks on the investment bank. The pledge came after Deutsche failed to agree a merger with rival Commerzbank. The overhaul signals that Deutsche is coming into terms with its failure to keep pace with Wall Street's big hitters. Sewing really wants to move the needle, said another person familiar with the plans. Founded in 1870, Deutsche has long been a default source of lending and advice for German companies seeking to expand abroad or raise money through the bond or equity markets, the role which had the tacit backing of successive governments in Berlin. Big cuts to its investment bank could make it harder for the lender to fulfill this role and would mark a reversal of decades-long expansion that began with the purchase of Morgan Grenfell in London in 1989 and continued a decade later by taking over Bankers Trust in New York. The investment bank generates about half of Deutsche Bank's revenue, but is also considered its Achilles heel. Revenue at the division is forecast to fall to 12.4 billion euros this year, according to a consensus of analysts. That would make a fourth consecutive year of decline, down more than 30% from 2015. in a shift that underscores its waning relevance within Deutsche. The investment bank would be represented on the board by sewing rather than having a seat at the table, as is currently the case, according to people familiar with the plans. To help finance its overhaul, Deutsche is seeking to lower the amount of capital that regulators require it to have on hand, according to 3 people with knowledge of the matter. The bank is aiming for so-called common equity tier 1 capital ratio of 12.5%, 2 of the people said, confirming a figure first reported by the Financial Times. The paper said it would free up 3.5 billion euros in capital. German prosecutors intensified Deutsche Bank client investigation, July the 3rd. German prosecutors are escalating a money laundering inquiry involving Deutsche Bank, including planned raids on wealthy former clients, a person with direct knowledge of the matter told Reuters. Frankfurt's state prosecutors will in the coming months search the homes of people who it suspects of using company formerly owned by Germany's biggest bank for tax evasion and money laundering. The intensified scrutiny of Deutsche Bank, which has said it has no indication of any misconduct, comes at a delicate time as the Frankfurt-based bank seeks to revamp its struggling business and repair a reputation ravaged by a series of scandals. The Deutsche Bank declined to comment on the investigation, but referred to earlier comments by a senior official in which he defended its record, saying that it has invested in fighting money laundering and that it is cooperating with investigators. Police searched the homes of 8 people in Germany as part of the investigation in May, after a 2-day search of the Deutsche Bank's headquarters by 170 police and investigators in November. That high-profile raid tainted it for months, hitting its share price as well as shaking confidence in the bank among government officials and customers. During the raid, police obtained names of 9,900 clients suspected of using its regular subsidiary to avoid taxes, the person said. Prosecutors said at the time that they suspected Deutsche Bank had helped clients shift criminal money, identifying more than €300 that had flowed into a British Virgin Islands registered vehicle in 2016. The prosecutors said they were investigating 2 members of Deutsche Bank staff. Deutsche Bank executive Karl von Rohr said in February that it had acted to ensure the tax honesty of clients and had no indication of any misconduct by the bank or staff. Regular was highlighted in data leaks, including the Panama Papers, which were uncovered by a consortium of journalists. The regional government in the German state of Hesse and a German federal police brought this data, which includes almost 290,000 documents relating to 1,500 offshore firms in 2017. It is now in the hands of Frankfurt public prosecutors. Although Deutsche Bank sold Regular early in 2018 to a Bermuda-based bank, the evolving question puts it under further pressure following years of scrutiny and billions of dollars in fines for schemes, including so-called mirror trades. Deutsche has agreed to pay more than $600 million in fines to New York and British authorities for that scheme, one of its most recent scandals that regulators said allowed Russian clients to covertly move money abroad. That prompted lawmakers in the US to send the banks a questionnaire asking about its money laundering controls. Deutsche Bank has been a flagrant offender of our money laundering laws, US Democrat Senator Chris Van Hollen told Reuters. They are in a league of their own, so we want to look at it for that reason. Von Rohr said in a speech that Deutsche Bank had improved controls, tripling staff who fight money laundering and financial crime since 2015, and was maintaining close contact with regulators. US lawmakers have also asked questions about the bank's relationship with Donald Trump, But Deutsche Bank's response has been held up by legal challenge by the US president, in which he accused the House leaders of harassment. In addition, the US lawmakers are also seeking information about Deutsche Bank's links to prominent Russians, as well as its money laundering controls. One person with direct knowledge of the matter said. The German bank has also come under pressure in a separate money laundering scandal involving Danske Bank, prompting European lawmakers to call it to reappear before the European Parliament over its money laundering controls. Ana Gomes, a Portuguese EU parliamentarian, and Sven Giegold, a German EU lawmaker, said they were disappointed by an earlier appearance in Parliament by Deutsche Bank. They did not answer in a way that would suggest they were reforming, Gomes said. July the 4th. Exit of Deutsche Bank's investment bank chief marks end of era. The head of Deutsche Bank's investment bank agreed to step down on Friday in a sign of the division's waning influence as Germany's largest lender prepares a multi-billion dollar restructuring aimed at reversing a decline in its fortunes. Chief Executive Christian Sewing will represent the investment bank on Deutsche Bank's board following the departure of division's boss, Garth Ritchie, who has been a deputy CEO with a board seat, the Frankfurt-based bank said in a statement. Ritchie, whose contract was extended last September for another 4 years, was Deutsche Bank's best paid board member in 2018, with earnings of €8.6 million. July the 7th. Deutsche Bank to cut 18,000 jobs in 7.4 billion euro overhaul. Deutsche Bank to axe vast swathes of its trading desks in one of the biggest overhauls to an investment bank since the aftermath of the financial crisis, in a restructuring that will see 18,000 jobs go and cost 7.4 billion euros. The bank will set up a new so-called bad bank to wind down unwanted assets with a value of 74 billion euros of risk-weighted assets. Some investors were cautious about the turnaround plan. Michael Hoonseller, head of credit portfolio management at Assignon Assets Management, said a lot had to go right for the plan to be successful. The margin for error is low, he said. Union Investment Portfolio Manager Alexandra Aneka said the steps were long overdue and noted the bank's aim to bring down its cost-to-income ratio to 70% was not ambitious compared with the international competitors. A person with direct knowledge of the matter said job cuts would be distributed around the world, including Germany. In the restructuring, Sewing let go 2 other members of the management board, head of regulation Sylvie Merhat and head of retail Frank Strauss, and brought in some newcomers. July the 7th. After Deutsche Bank cuts, will there be growth? Where will the growth be? For Deutsche Bank Chief Executive Christian Sewing, shrinking the group's investment bank will be relatively easy, if expensive, part of his restructuring plan. Finding steady revenue streams to produce 7.4 billion euros, the bank expects in charges from cutting down its trading arm will be more than challenging. Germany's biggest bank said on Sunday it planned to focus on corporate banking, foreign exchange, deal-making, asset management, and private banking. All these areas potentially could provide less volatile revenue streams than the bank's equity rates and trading arms, but they are already fiercely competitive and undergoing sweeping technological changes.
In asset management, Deutsche Bank's DWS arm is seen as another of its strong points and one the bank leaned on to extract last year when it listed 22.5% of the business. But with the sweeping rise of passive investments, asset managers need scale and technology to compete. Deutsche held talks with rival UBS earlier this year about a merger of their asset management arms, but talks broke down due to a clash over who would ultimately control the business. A broader challenge for Deutsche is technology, with the lender trying to update legacy IT systems that are blamed in part for the bank's failure to control costs, while also keeping up with the wave of fintech innovation in the industry. Deutsche has established a board-level technology, data and innovation committee to tackle this, and in a memo to staff on Sunday, Soing said Deutsche Bank would invest €13 billion in technology by 2022. That should help, but will it be doing so amid a technology arms race in banking? Research from UBS earlier this year found that JP Morgan had budgeted $11.4 billion for technology in 2019 alone. July 8th, Deutsche Bank capital boosting debt dips on restructuring fears. Deutsche Bank's capital boosting additional Tier 1 debt issues fell on Monday on worries over future challenges Germany's biggest lender may face in a planned overhaul. Concerns centered on Deutsche Bank's decision to lower minimum capital buffers, a pool of assets designed to absorb losses after it launched one of the biggest overhauls of its investment banks since the 2008 financial crisis on Sunday. The debt had earlier risen after Deutsche Bank said it would pay coupons on its bank capital debt. A substantial restructuring was needed to address the bank's sluggish performance, ING analyst Suvi Platanik Consonon said, adding the measures involve substantial execution risks and lowering the capital buffers makes the bank more vulnerable to any headwinds. July 8th, European shares dip on Deutsche Bank, fading hopes of sharp Fed cut. Shares in Deutsche Bank, which had jumped nearly 4% in the morning trade after a German lender once announced one of the biggest investment bank overhauls since the aftermath of the financial crisis, reversed course to close 5% lower as investors questioned the bank's restructuring targets. The bank laid off staff from Sydney to London on Monday as it began 18,000 job cuts in a €7.4 billion reinvention, which it said would mean yet another annual loss. When banks come out with a cost number, there's often quarterly attrition on that number through the execution phase. Therefore, the risk is slippage on the targeted net cost saves, Russell Quelch, financial analyst at Redburn, said. There are already doubts around the starting point for revenues given the weakness in the first 2 quarters of 2019. Deutsche Bank careers end in an envelope, a hug, and a cab ride. July 8th. Summoned to HR to be handed a Deutsche Bank envelope, many of its staff across the world then left their desks for the last time on Monday, shown the door by their German employer within hours of a restructuring announcement. Deutsche Bank confirmed on Sunday that it was closing huge parts of its trading business and with staff in its equities division in Sydney and Hong Kong among the first to be told their roles would go. If you have a job for me, please let me know, said a banker leaving the Hong Kong office on Monday. Staff leaving Hong Kong were holding envelopes with the bank's logo. 3 employees took a picture of themselves beside a Deutsche Bank sign outside, hugged, and then hailed a taxi. They give you this packet and you are out of the building, said one equities trader. A few hours after the Hong Kong staff left, workers were seen leaving Deutsche Bank's office in the City of London, which, along with New York, is expected to bear the brunt of the cuts, carrying similar envelopes. "I was terminated this morning, but that was a very quick meeting and that was it," said one IT worker who left while Deutsche Bank's chief executive Christian Sewing was inside the building doing a call with the media. Few staff wanted to speak outside the bank's London office, but trade was picking up at the nearby Balls Brothers pub around lunchtime. "The job market in equities is going to be very tough," said George Kuznetsov, head of research and analytics at Coalition, which analyzes the investment banking industry. "Our expectations, if for equities sales and trading revenues falling 7 to 8% this year, and that of course is going to put a lot of halts into the hiring across most of the brokers." For Deutsche Bank staff whose jobs are safe for now, there was some relief, but also big doubts about the future. "The biggest question for us is where do we go from here if we don't offer the whole suite of products? Will clients stick with us or is the game over?" said a Singapore banker who remains in his job. Doubt over Deutsche Bank turnaround plan dents shaky shares. July 9th. Deutsche Bank shares extended losses on Tuesday on investor doubts that its chief executive can revive the lender by shrinking the investment bank and returning to its roots as a banker to corporate Germany. Christian Sewing, CEO for just over a year, and his finance chief are on a week-long roadshow to explain the restructuring. To underline his commitment, Sewing plans to invest a quarter of his fixed salary, around €820,000, in Deutsche shares. Deutsche's stock price has fallen 10% since Sunday's restructuring announcement to cut 18,000 jobs in a €7.4 billion reinvention. It is the biggest two-day decline in almost 3 years. There seems to be some concerns around the plan details, particularly the ability for the bank to retain revenues while cutting costs, one of the bank's top 25 shareholders told Reuters, citing worries the bank would need fresh equity to execute Sewing's plan. Analysts with RBC Capital Markets wrote that the bank's outlook for revenue growth was ambitious and there was a high degree of risk associated with implementing the plan. At least one big investor was sold on the proposals. Douglas Brownstein, who holds a 3.1% share in Deutsche through his New York-based Hudson Executive Capital, said it would take a while for the market to appreciate what Deutsche Bank is doing. "Going back to basics for this 150-year-old company is ultimately going to be a very successful strategy decision," he said on CNBC. So this is the Deutsche Bank stock chart. As you can see, it reached the highest of the last 5 years around April 2015 at just under €30 per share. It's had a very rocky decline since then and is currently stood at €650. So we will see what happens over time there. The chart in general does not look encouraging. That very much looks like a decline.